Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're talking about investing basics for women. As you've probably seen, there's a lot of great information here for anyone, of course, but in particular, when it comes to investing, understanding these principles that I talk about as far as asset allocation, the importance of asset allocation, diversification, all of these things, and then how to apply these principles properly. And then we're going to get into that some more. So one of these for investing basics is understanding the difference between active investing and passive investing. Okay, another way to look at that is active investing, active management of funds, and indexing. So an actively managed fund, you can tell, you know, there's a lot of buying and selling. So if you look at a turnover ratio, so an example would be a typical large cap mutual fund that's actively managed might have 50 to 100 stocks. Now, keep in mind, I said large cap, right? Remember what I said about the S&P 500 index, the 500 largest companies in the United States? So basically, these large cap stock funds are utilizing stocks within the S&P 500 index. They're seeking to beat the S&P 500 index performance by picking the best stocks out of that 500. That's the premise. Does it work? No, it does not. Okay, and there's a lot of research that shows that it doesn't. But that is what active management is about. It's an investment strategy seeking to outperform the market by stock picking or selecting these individual stocks and securities. Now, the problem with that, and you can get into bond funds, by the way, work the same. But let's stick with this stock thing because it's easier to match up with the S&P 500 index. The index beats, as I mentioned, 90% of these mutual funds. So therefore, and again, the 10% is just, it's not the same guys. They just get lucky and then they go away. And then they underperform. So if we wanted to consistently beat the market, all right, the basic research shows you're not going to do that. What you can do is you can get a market return by buying the index fund, and then by blending indexes together, we can reduce that risk, that volatility of the S&P by itself, and still get a market return as well. And I'll show you how we do that. All right. So, but the difference is, again, active management. That's where they're doing a lot of buying, selling. When you come into my office, for instance, when I do investment analysis for the first time, one of the things we dig into there is understanding about whether, how this active management works. So typically on a Morningstar report, you'll see again 50 to 100 stocks in a large cap fund, and just below that, where it's showing those holdings, it'll show what's called a turnover ratio. And a turnover ratio, you typically see from 30 to 130%, meaning that let's say they picked 100 stocks as an example in that fund. They're going to sell 100 and buy 100 new ones because why? They said, well, this is going to beat. Oh, it's not. It's underperforming. Oh, let me go try again. So basically, there's this kind of buying and selling going on with that, and within that fund. This generates transaction costs, which are going to reduce your net return. And this is one of the things when it comes to when you look on your statements, for instance, you won't see transaction costs. You won't even see it in a prospectus. But if you look at that turnover ratio and understand that anytime they're buying and selling, there's a cost to that. Right? They're paying someone to place those trades as an example. That reduces your net return. Okay, you also will typically see much higher fees when it comes to active management. And this is one of the things we'll get into in a little bit too about costs and the importance of those. So indexing is where an investing strategy that's looking to track market performance by holding securities in an index such as the S&P. And as I mentioned in modern portfolio theory, we want to blend different asset categories, which means different index funds together to create a portfolio that's going to reduce that risk and still give us that market return. So let's start now with the goals. Okay, so on our next slide, investing principles, understanding, again, first your investment goals, preserving assets, maybe paying for education, funding retirement, whatever your goals are for your money. Maybe you want to save up for a vacation home, whatever it might be. You start there. What are my investment goals? Because that also says, you may have an investment goal that says, well, I just want to save up some money and I want to buy a car in 3 years, okay, and pay cash for it. Well, that's great. In fact, in retirement, hopefully that's exactly what you're going to be doing, is paying cash for the vehicles that you purchase. Now, when it comes to that goal, though, that's a short-term goal. And that's where, when you're setting goals, because you're identifying the time horizon that those monies are going to be invested, is another part of that. Paying for education. If you're putting together a 529 plan or investment plan for a grandchild that's, say, you know, under 10 years old, obviously that's going to be in there for a long time. Another longer time. So now we're talking about not just a few years, but maybe we're talking about 8, 10 or more years. And then funding retirement. Well, now that's lifetime, because that's, you know, both the saving up for retirement as well as the living on those monies in retirement. So that's a lifetime investment. Different time horizons mean different investment portfolios. In other words, how we balance out the stock to bond quotient as well as other things that we're going to use. The constraints that we talk about when it comes to goals, the level of risk you're comfortable with, all right, that goes into asset allocation as well. How long before you'll want to draw on your investments, again, that time horizon I was just mentioning, and then your income or liquidity needs. And this is where we get in again, having an emergency fund and a short-term fund are real important. And then, of course, always tax considerations, because it's not just what you make, it's what you keep. And if we can minimize taxes, you get to keep more, and that's going to help you attain your goals. And one of those goals being never running out of money. Well, your money's going to last a lot longer if you're not paying a lot of taxes, right? If there's a way to minimize taxes, you want to take advantage of that and keep that money in your pocket. All right, let's look at the next thing, balance, starting with an asset plan. This goes with what I was saying. Long-term investment outcome is largely determined by your asset mix. I've talked about this many times on the show. I've shared with you, separating myths from truth and other type programs that get into the importance of asset allocation. Asset allocation is the biggest determinant of what kind of return you're going to get on your portfolio, as well as what kind of risk or volatility you're going to have. Only 12% of what's going to determine those results are based on stock picking and market timing. And we avoid those. Those things can get you in big time trouble and cause you potential big losses or lost returns on your portfolio. So diversification is another part of that. That's what's going to help mitigate risk, and that's why blending together stocks and bonds, possibly adding fixed index annuities into that mix to help further reduce that risk, is a big part, and increase the return at the same time. So developing a suitable asset allocation model is the most important piece when it comes to investing. One of the things, I'm going to take a quick little number here again, because it's so important. If you'd like to, hopefully it's going to help you, but if you'd like to see how these principles apply, and you'd like to get a personalized plan, just be one of the first 10 callers to my office this morning, 615-376-5325. Tess is I'm going to keep this short. Tess is standing by. She'll get your information. If you'd like us to show you how to construct that portfolio for your specific needs, and to get the needed rate of return for you, and to do this whole comprehensive plan, right, that at no charge, be one of the first 10 callers. 615-376-5325. Tess is standing by to get your information. She'll send you out a little packet of things to bring and a checklist of things to bring to your appointment with me. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. In that book, by the way, I cover a lot of this. The first 2 chapters are about the fundamentals of financial planning I've been talking about a little bit. Chapter 3 is about taxes. It's IRA mastery. This shows you how to minimize taxes in your retirement accounts, for instance, and gets into other tax things like Roth IRAs as an example. Chapter 4 is on safe money, things that we were just talking about, liquidity possibly, but definitely how to, certain monies that you want to keep safe and protected. Chapter 5, how the smart money invests, what we're talking about today on asset allocation, among other things. Chapter 6 is on long-term care and alternatives to just long-term care insurance as ways to take care of that risk. And then Chapter 7 is on estate planning, and we get into the difference between wills and trusts, and we talk about the 5 essential documents that form the foundation of a good estate plan. All right, such as a trust and a pour-over will and power of attorney for assets and power of attorney for health care and a living will. So all of that's covered, and that's yours if you're, when you come in. All right, now back to investing principles. Minimizing costs is the next piece of this. So we talk about asset allocation. That's important, and next to that, that's the highest priority. Then the next piece is about how to minimize costs. So costs can create an inevitable gap between what the market's return and what you get to keep. In other words, if you've got, sometimes people come in, I talk about fixed index annuities as an example. Well, there's also something called variable variable annuities. Variable annuities are basically you're investing in the market through these sub-accounts, which are much like mutual funds, right? But what's the difference? You got higher costs, higher fees. And these fees I typically see are anywhere from 2.5% to 3.5% or more per year in fees. When you can, to put in perspective, the portfolios that I talk about, the fees on those all in are about 1.2. So you're talking about fees that are 2 to 3 times as high, okay, to invest in the market. That's why I say avoid variable annuities. When you get into annuities, there are like 1,000 different products out there. 75–80% of them are variable annuities, so you can see why if someone's telling you, watch out for annuities, well, those are the ones they're talking about. And the importance, even with index annuities, even with fixed annuities, is still making sure you understand, some of those can have high fees. So, and some of them have caps or limits that keep you from making as much on them. So it's real important to understand how these things work and how you're going to minimize cost in your investing. All right, I'm going to have to take a quick break again. I'm going to stop right here for a moment. Quick break. Join me here. We'll be right back on the Retirement Report.